Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to customer credit policy, which will include calculations related to the turnover ratios and return on investment, or ROI. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 731 Customer Credit Policy, Turnover Ratios, and ROI tab in the Practice Problems section. Closing this back out, we're going to go through the information for the problem up top, then we'll have a smaller component of the information that we will use to work through the practice problem. So we have a credit policy to increase credit sales. We're going to have a credit policy change that we will believe will increase sales. We're going to project an increase of the sales at the 480,000. The strategy will need investments in accounts receivable, inventory, and property, plant, and equipment. In other words, we believe that the strategy that we have in place will result in increases to these asset accounts. And whenever we have an asset buildup as part of the plan here, we can think of that kind of like an investment in order to generate the revenue. And we can do a calculation for an ROI, return on investment type of calculation, and see whether or not that can be a tool we use to see whether or not the strategy would be worthwhile to do. Now, if we're projecting out into the future, then we can use some of our turnover ratios in order to figure out what we believe the asset buildup will be. So that means that we're going to take our accounts receivable turnover, inventory turnover, PP&E or property, plant, and equipment turnover ratios that we did on prior financial data, on past data, use them then to project out into the future based on the sales that we have now to see what we think then the asset buildup will be for accounts receivable, inventory, and PP&E. Then we have all the sales are expected to be collectible. So we're not going to say that we have the uncollectible portion of the sales at this point in time. We believe these are the sales that we believe we're going to be collecting on, is that increase in sales. So the collection costs of the sales, production, and selling costs, the collection costs as a percentage of sales will be 4%. It's going to cost us 4% for the collection, production, and selling costs are 72%, because remember, we're talking about sales increasing, which is the top line. Therefore, we have to think about the normal costs that would be there in order for us to consider the bottom line, which is basically net income, which would be grouping together the production and selling costs. Then we have the cost to hold the inventory as a percentage of inventory, 4%, because now we have the inventory and we have costs related to the asset buildup of the inventory. We have the depreciation expense on the PP&E, the property, plant, and equipment. So remember, property, plant, and equipment is going to be a function or a format or something that needs to be built up in order to have this increase as well. There will be then the allocation of that cost in the form of depreciation on the income statement. Also note, whenever we're thinking about PP&E, we also have to think about, more in depth in terms of the cost of the property, plants, and equipment, how long it's going to be used for, possibly time value of money. We're not going to get into that here. We're going to be analyzing basically the allocation of the cost in the form of the expense to calculate basically our return on investment, one component that might be considered when thinking about a big purchase of something like property, plants, and equipment. Tax rate's going to be the 30%. Then we have our information down below in a smaller component, so we can then see it as we work through the practice problem. So what we want to do then is we want to start figuring our asset buildups that we think are going to be taking place. That's going to include the receivables, what's going to be our increase in the receivables, increase in inventory, increase in property, plant, equipment, if we assume that we have the 480,000 increase in sales, and we can use that then to think about what our return on the investment would be, comparing basically our net income, or what we expect the net income to be increasing by, to the asset buildup that we will be calculating here. So what we want to do then is really figure out then accounts receivable, inventory turnover, and PP&E. To do that, we have the turnover ratios, which of course in practice, which would have been from the prior period, that we can use to project out forward. Now you might then think, well, I'm going to use these turnover ratios and need a new formula to calculate accounts receivable. But that's not really how you want to think. Remember, what you really want to usually do is say, okay, I'm going to use this accounts receivable turnover formula, and then just plug in the unknown instead of learning a new formula, which is basically just doing an algebraic, twist in your mind, just reformatting it algebraically. So what I want to do is say, okay, I got the accounts receivable turnover. I'm trying to figure out what accounts receivable would be, projecting out to what accounts receivable would be with the use of that. I'll just use that formula. So what is the accounts receivable turnover formula? It would be the sales, 480,000, divided by the accounts receivable, which is the unknown. That's why it's yellow, even though there's a number there. And that would give us the accounts receivable turnover, which is known. So then the unknown would, of course, be the 80,000 in our scenario here. And we're just putting in the formula on something that we know instead of trying to reformat it or memorize something different. Then if I was to write this out algebraically, it would be 480,000 divided by 80,000 equals 6. And then you could solve for x. I mean, it'd be 480,000 minus or divided by x, which would be the unknown, equals 6. And then you could solve for it, which would be 480,000 divided by 6 is the 80,000. You could double check that by saying, okay, does that work if I take the 480,000 divided by 80,000 is the 6. Now, if you were to rewrite this, of course, if you were to ask somebody about this formula, they might just give you the new formula. They say, well, how do you determine accounts receivable? You take the sales of 480,000 and then you divide by the 6 to get to the 80,000. But again, you don't really memorize this formula, or you don't have to. You just plug in the formula that you have learned when you're thinking about ratio analysis on the financial statements, rather than using formula or memorizing formulas on how to make financial statement account balances using the ratios, right? So anytime you're asked to project to some number that is on the financial statements for an account on the financial statements, you don't want to think about, okay, what's the accounts receivable formula? You want to think about what ratio formula that you have that would include that number in it, and then back into the unknown, which will be the receivable balance. All right, then we're going to do the same thing for the inventory. So we think that there's going to be a change in the inventory. So we're going to base that on our inventory turnover. Same kind of thing. I want to figure out what the inventory projection will be. I'm not going to learn a new formula. I'm going to use the turnover formula and then look for the unknown, which is going to be the projected inventory. So once again, the turnover is the thing I normally calculate on the financial statements. When I'm projecting out into the future, I'm going to use this formula, which I normally know, to figure out the financial statement amount, which is usually the thing I do know when I'm doing this kind of analysis on financial statements. So then I'm going to use the formula in order to back into the financial account that I don't know, all right? So we got the sales, the inventory turnover is usually sales. Now, you can also have inventory turnover as cost of goods sold. You can use sales or cost of goods sold. If you want to go back to prior presentations when we went over these ratios based on financial statements, we'll go over kind of the argument of when you would use sales or accounts receivable. We're using sales here. So sales divided by the inventory, which would be the unknown, would give us the inventory turnover, which is 4, which we know here. So then once we have this formula, we can write it down algebraically if we so choose, which would be the 480,000 divided by X would be 4. And then you can solve for that formula or for the unknown, which would be 480,000 divided by 4 would be 120,000. We could double check that by saying, does that work? 480,000 divided by 120,000 equals 4. Again, if you were to ask somebody about this, they would say, hey, if you have this information, you calculate the inventory investment, the inventory projected amount, by taking the sales divided by the inventory turnover to get to the 120. But of course, this is just a rework or just a re-algebraic change of the formula we did up top, and it's not necessary to memorize that. It's easier to memorize the ratios. So anytime you're looking at something that is a financial statement amount, then you probably don't want to memorize a formula. You want to know what the ratio related to it is and plug in for the unknown. Same thing for the PP&E, or the property, plant, and equipment, the depreciable assets or the fixed assets, all different names for the same thing. We're going to say that needs to be increasing as well. We're going to look at the turnover ratio for it from prior financial statements and figure out what we think the PP&E should be, or projected to be, based on the future sales. So we're going to do the same kind of process. I'm not going to do a new formula for PP&E. I'm going to look at the turnover calculation, which would be sales divided by the PP&E, which would be the unknown, which would give us what we do know at this point, the 2, which is the PP&E turnover, property, plant, and equipment turnover. Then we can write down the algebra for the unknown, 480,000 divided by x equals 2. Solve for the unknown, 480,000 divided by 2, giving us the 240,000. We can double check that by saying, does that work? 480,000 divided by the 240,000 gives us the 2. It does indeed look like that is the case. Once again, if you were to ask someone how to calculate that given the data, they might rework the algebra and simply give you a formula to figure out property, plants, and equipment as if you need to memorize it, but it's just the rework of the algebra of the turnover formula. So you should probably just focus on memorizing the turnover formula. And so if you reworked it, did the algebra, sales divided by the PP&E or property, plants, and equipment turnover gives you the 240, once again, another calculation for the same number that we had up top. So now we want to go to the incremental income statement and see what would be the effect on the bottom line, basically the net income after taxes. They gave us the top line. That's what we're assuming to be taking place, the 480,000 sales. Now we got to figure out the bottom line, which is basically our return on what's going to be happening if we make this change to determine if it's worthwhile to do so. So incremental income statement, we're going to say that the sales are going to increase by the 480,000. Then what are the expenses related to that increase? So these may not be in the same order that we would see on a standard income statement because we're looking at those expenses that we think are going to be directly related to this increase in sale, but it's a similar format, of course, to what the income statement would look like. We're going to say the collections costs. So we had an increase in the collections costs, which we said was 2% of the sales. So this 480,000, they're sales on account. Therefore, we're going to have collection costs related to them, which we're going to say is 4% in order to get that money, to nag the customers to say, hey, you owe us like money. And so that's going to be the 19,200. Then we have the production and selling costs. So we're going to say that's going to be a percent of sales as well. These are kind of like the normal expenses that would be, part of our production process or selling costs that we would normally have. We might get this from kind of like basically starting with the profit margin and taking, 100% minus the profit margin to start with to think about what the production and selling cost percentage of sales would be. So we're going to say then we got the 480,000 divided by the 0.72. That's going to be the 345,600. Then we have the inventory holding costs because now we had an increase in the inventory. It's going to cost us to hold on to that inventory, which we believe is going to be 4%. This time 4% of the inventory. So up top we said, all right, the inventory was up top here at the 120. So 120,000 times 0.04 is going to give us a cost of 480 or 4,800. And then the depreciation is going to be 20% of the PP&E. So we had an increase in the PP&E we calculated at the 240. So 240,000, we're going to allocate the cost in the form of depreciation, 20% here. So times 0.2 or 20%, that'll give us the 48,000. Then if we add these up, we're going to say the total cost, then let's do it on the calculator. You can see it there, but I just feel like typing it in there just for the fun of it. We got 19,200 plus 345,600 plus 4800 plus 48000, and that gives us the 417,600. And then we're going to say that we have the income before taxes, which is going to be the sales amount, 480,000 minus the 4176 gives us the 62,400 there, 62,400. Then we have the taxes, which we said, what's the rate on the taxes? 30% tax rate. 30% tax rate. So we're going to take the 62,400 times 0.3. That's going to give us the 18,720. And then if we take the 62,400 minus the taxes, 18,720, we get to the 43,680. That's going to be our bottom line, basically net income number. All right, so once we have the net income number, we can then think about our return on investment. So our return on investment. Now remember, like anytime we have an increase in the assets, we can think of that kind of like an investment and calculate basically an ROI, return on investment. We had an increase in the assets of accounts receivable, inventory, and PP&E, property, plant, and equipment. So if we take then the income after taxes. This is our return that we had, basically our net income number here that we just calculated up top on the incremental income statement. And then we take the investments, which we're going to say all the increase in the assets, which was the 80,000 increase in accounts receivable, inventory, and property, plant, and equipment. Inventory 120,000, PP&E 240. That's what we calculated with our turnover ratios up top. Let's just check it out. Turnover ratios. We had the 80,000 accounts receivable, inventory 120, PP&E the 240. That's where those come from. And that's going to be added up, the 80,000 plus the 120 plus the 240 increase in the assets of 440,000. So then if we divide this out, we're going to take the 43,680 increase in net income divided by the increase in assets, which basically is like our investment, 440,000. And that's going to give us our return of about, moving the decimal over, 9.93. Now, obviously there could be rounding. There's rounding involved here, so about 9.93%. So once we have this kind of return on investment, we can use that in a similar way that we would use other return on investment type of calculations to consider if it's above a certain threshold to see if we would want to make the change or not. And remember, when arguing for a change, we have to assume that the default gets the privilege of we're sticking with the default unless you have a significant argument to tell us to do something different in order for us to take on the risk of the change. Therefore, many companies will have a bottom line threshold, such as a return on investment type of threshold. Now, also note with this particular proposal, we also have the property, plant, and equipment investment that takes place as well. That's going to be a longer term type of thing that we can't really change as easily. So we might do some more analysis in terms of any change to the PP&E in terms of time value and money, and what the ultimate effect would be for the cash flow, for the investment in the property, plant, and equipment. And if it's a significant investment up front in terms of cash flow, what alternatives we might have in terms of investing that cash flow, what related other ROIs, return on investment, we can do with it if we were to do something other than put it into property, plant, and equipment.